If you haven't yet, I suggest that you look at the PowerPoint presentation that I put on Canvas before you watch this video. It shouldn't take but just a few minutes. In that video, I talk about a little bit about the capital budgeting process and the different methods that companies can use to analyze investment alternatives. In this video, I'm going to walk you through how the different methods work. That's why it's important that you have already looked at the PowerPoint so that you are familiar with what I'm going to be talking about. So the data I will use in these examples is we're going to assume that we want to purchase a machine that will cost $225,000. It is our belief that the purchase of that machine versus whatever else we were doing will reduce our operating costs by $48,000. We're going to keep it simple initially and just say we don't anticipate any salvage value with the machine when we're through with it. We anticipate a useful life of 8 years, and we have a required rate of return in the company of 8%. So you'll remember from the PowerPoint video that the 4 methods we're talking about in this class are the net present value method, the payback method, the internal rate of return method, and the accrual accounting rate of return method. I'm going to walk us through the net present value method first. This is the method I would argue most companies use. And remember from the PowerPoint that this method does take into consideration the time value of money. So you will need to think back to present value assumptions. So the whole idea with the net present value method is to determine effectively what the net present value, the discounted value is of the cash flows associated with this acquisition, in this case, this machine. And the discount rate that you would use is whatever your required rate of return is. The idea being, if I require a rate of return of 8%, as in this scenario, and I calculate the net present value of my anticipated cash flows, and that net present value is 0 or positive, then I'm achieving my required rate of return. If that net present value is negative, then the required rate of return that I'm actually achieving is going to be less than what I require. So keeping in mind that what you're looking for is a net present value that is greater than or equal to 0. So here are our cash flows. In this scenario, we basically have 2 streams of cash flow. The first one is our original investment of $225,000. And let me back up here just briefly. I'm going to walk through this calculation using the tables in the book, and then I'll walk through it using Excel. So first off, using the tables, our investment of $225,000 is an outflow. It happens today, so that initial investment does not need to be discounted. The factor is effectively 1. So our present value and our cash flow stream is the same. Then the next cash flow is the savings that we will generate of $48,000 a year. That's, in this case, that's the same dollar amount every year. So we can calculate that using an annuity. So we have 48,000, and then I identified the factor from the present value of an annuity table for 8 periods and 8%. I then multiplied those 2. That gives me positive cash flow of $275,856. In this example, those are effectively the only cash flow streams. That leaves us with a positive net present value of $50,856, which, based on dollars alone, quantitatively examining it, this would be an appropriate investment to make. Now, let's walk through this using Excel just in case you want to use Excel. Again, the investment is day one, so there is no present value. The 48,000 is an annuity again. So what I did was I substituted in the Excel formula the rate of 8%, the number of periods of 8, and then this is a payment of the 48,000. And we come basically to a similar answer. Again, just like I talked about in the time value of money video, there may be a few dollars different from a rounding perspective. Okay, so net present value, we would say, okay, this is a viable alternative or investment. The payback period, as I talked about in the PowerPoint, is an approach. It ignores the time value of money. What it does look at is how quickly am I going to recoup my original investment. Now, in our case, our cash flows are equal over the 8 years. So all we really need to do is take the investment of $225,000, the annual operating savings of $48,000, and we divide the 225 by 48, and that says the payback period, if you will, is 4.69, which effectively says we will recoup our investment in year 5. And then we'll evaluate whether or not we're comfortable with that. Okay. All right, the internal rate of return method is a little trickier. It requires a little bit of actually guessing to some degree. What you're going to do, you're going to take, again, the internal rate of return is the rate of, the way this method works is you determine the rate of return that causes effectively a net present value of 0. The present value of your outflows equals your present value of inflows. And then you determine if that rate is equal to or exceeds your required rate of return. So using the tables, what I did on this was I took the 225,000 investment, I divided it by the annual savings, which basically says the factor that we would need for those to equal would be 4.69. Then we've got an 8-year life, so I went to the tables and I determined that the 4.69 factor on the 8-year line falls between 12 and 14%. Okay, we know we have a required rate of return, so if it falls between 12 and 14, then we certainly would achieve our required rate of return. But we can determine what the exact IRR is by looking at the present value factors for the 12 and 14. So what I did, we basically are interpolating what it would be. For 12%, the present value factor was 4.968 at 8 years. You can go to the table and see that. For 14%, it was 4.639. So that's how I arrived at the idea that the rate of IRR falls somewhere in between 12 and 14. Then the IRR factor is 4.688. That this cell is actually, let's extend that. That cell was rounding at 3. So what I'm going to do is I'm going to take the difference between the present value factor at 12% and 14%. Then I'm going to take the difference between the factor at 12% and the IRR factor. And I'm basically going to add to the 12% a proportionate amount of the 2% difference between 12 and 14. That makes sense. So in other words, my RRR rate will be 12% plus the ratio of 0.281 divided by 0.329 times the 2% difference between 12 and 14. And that effectively gives me an IRR of 13.7, which falls between 12 and 14. So the internal rate of return is sometimes not as straightforward as the net present value method. The final method that I want to talk briefly about is the accrual accounting rate of return. The downside of this method is, again, we are ignoring time value of money. The NPV, net present value, and IRR methods are the only ones that take into consideration time value of money. The other thing that we're doing with the accrual accounting rate of return is we're looking at accrual-based income, which means we're not looking at cash flow. So what we're going to do here is we're going to take this annual savings of $48,000, but that new piece of equipment is going to have depreciation. That depreciation isn't a cash flow item, so we've ignored it in the other examples that focus only on cash, but it is a depreciation. And so it is an expense, sorry. So what we're going to do is I calculated the depreciation by taking the initial cost and dividing it by the useful life. We're just doing straight line. Then I basically subtracted that from, well, and then you've got the initial investment. I, in essence, took the $48,000 in savings, backed out the additional non-cash expense of depreciation to arrive at the actual income earned on this investment, and then I divided that by the investment. And what we come up with is an ARR of 8.83%. And then we have to determine what our required accounting rate of return is. It's obviously less than the IRR because it takes into consideration the non-cash expenses. All right, I'm going to stop this video here, and I've got two more examples I want to discuss that expand on the net present value example.